Hey everyone, my name is Luke and I'm a financial planner by day, here to share life lessons that I find interesting and valuable with you all. For the past few years, one of my financial goals has been to put a big down payment on my next house. The idea was that by doing this, I could keep a mortgage payment as low as my current one, even if the purchase price was higher on the new house. Although the idea of owing less to the bank, paying less interest, or even paying off something entirely feels great, the recent LA fire has made me rethink this whole feel good, pat myself on the back kind of move. As I reflect on this event and my financial planning principles, I wanted to share some reasons why making a bigger down payment more than necessary can devastate your financial life. Number 1. Tying up too much cash. A large down payment might seem like a smart move. You lower your mortgage and pay less interest. But the downside is that you're locking up a massive amount of cash in a single illiquid asset. That decision comes with serious financial trade-offs. First, there's an emergency fund impact. Life happens unexpectedly. Home repairs, medical bills, job loss, or even a disaster like a fire can hit when you least expect it. If you put too much into your house, you don't have a quick access to that money when you need it most. A home isn't a saving account you can easily pull from in an emergency. Then there are missed opportunities. When you put all of your money into your home, you limit your ability to invest elsewhere, whether that's in stocks, bonds, crypto, or other assets that could be growing your wealth. A house may appreciate over time, but historically, diversifying investments tends to outperform relying solely on home equity. Unlike stocks or liquid assets, extracting cash from a home requires refinancing, selling, or taking out a home equity line of credit, all of which take time and may not be ideal in a crisis. At the end of the day, financial security isn't just about owning more of your home. It's about having multiple streams of growth and protection. Spreading your investments ensures you're not putting all of your financial future into one asset that you can't easily access when it matters most. Number 2, insurance and natural disasters. A lot of homeowners assumes that insurance will make them whole if disaster strikes, but the reality is that payouts don't always cover everything. Policies have limits, fine prints, and exclusions that can leave you with a major financial gap when you need it most. If something catastrophic happens, like the LA fire, insurance may only cover the home's assessed value, not necessarily the full cost of rebuilding or replacing everything you lost. While home values tend to appreciate over time, that's not always the case. If you own the home for a long time, it's possible that the appraised value is higher than what you originally paid for, meaning you might have some built-in equity. However, in a certain situations like a declining market, an overbuilt area, or a disaster that makes the neighborhood less desirable, the home's assessed value could actually drop. Another point to consider is that even if your home is destroyed, you still owe mortgage payments. If you sunk a huge portion of your wealth into the house, that's money you can't get back. It's trapped in an asset that no longer exists. A smaller down payment and a diversified investments mean you have other resources to fall back on instead of having all of your equity locked up in an unproductive asset. Although it's true that many Americans rely on home equity to build wealth, it shouldn't be your only store of value. Diversifying ensures that even if disaster strikes, you're not financially wiped out, stuck waiting on an insurance check that may not cover everything, or tied to a mortgage on a home you can't even live in. Number 3, the risk of too much equity and falling resale value. When you put a large amount of cash into your home, you're essentially prepaying your mortgage and concentrating your wealth into a single asset. While this might seem like a good idea, it becomes a serious problem if you ever need to sell under duress, whether due to a disaster, financial hardship, or a declining market. If resale values drop, especially in fire-prone areas where rising insurance premium and risk concern push buyers away, you may struggle to recover your equity. In some cases, lenders may even restrict financing in high-risk areas, further reducing demand and driving prices down. A slow housing market means fewer buyers, longer selling times, and a greater chance that you have to sell at a loss. If most of your wealth is locked into your home, you're the one taking the biggest financial hit. At the end of the day, homeownership is more than just a financial milestone. It's a long-term investment that needs to be approached strategically. While putting down a large sum may seem like the responsible or secure choice, it's important to consider the risk that comes with locking up too much of your cash in a single asset. The recent LA fire has been a wake-up call, reminding me that financial flexibility matters just as much as financial security. A house can be rebuilt, but financial setbacks like losing access to your savings, being tied to a devalued home, or facing unexpected costs without liquidity can be much harder to recover from. If this video has helped shift your perspective or given you something to think about, please share your thoughts with me in the comments. And if you found this information valuable, consider liking and subscribing for more financial insights and life lessons that I have learned from my diverse pool of clients. Thanks for watching, and I'll see you next time. Peace.